And we have a news alert here on the Fed. The Board of Governors has voted unanimously to reappoint the regional bank presidents for 5-year terms beginning on March 1st, 2026. Typically a routine vote. There have been speculation about whether the administration would try to influence the reappointment process. But today's announcement was unanimous, meaning even Stephen Myron, on loan from the administration, was in favor of these appointments. Now, in recent years, reappointments have taken place in January or February. So this vote is coming considerably earlier than expected. Well, from AI to gold miners, Bridgewater's former chief investment strategist is positioning for another winning year for stocks. Rebecca Patterson joins us here on set. Rebecca is now senior fellow at the Council on Foreign Relations. Rebecca, welcome. It's great to have you on Fast Money Live night.
I know, this is so fun. So fun. You in the hat?
Well, the hat was good, right?
Love the hat.
Want to get to your 2026 playbook. It sounds like you think that there's a bullish consensus sort of forming. And part of that bullish consensus is what the Fed did yesterday and what it paves the way for. Your reaction to the bullish consensus, though, is what fascinates me in terms of maybe you don't want to be all in on that.
I'm a tempered bull.
Right.
So there is a consensus that we're going to have 2% GDP growth next year. We're going to have even faster earnings per share growth. All of that's going to be supported by more Fed cuts, more stimulus, the big tax refunds coming through, more share buybacks coming through with tech and finance. And you saw Treasury Secretary Besson today. He is pushing hard to get deregulation to move even faster. It's reasonable. Like, that is a totally plausible narrative, plus the AI capex, of course. The problem is that's what's priced in. And so you have to think, do I want to have a little bit of diversification in my portfolio in case all the good news is priced in? The reality isn't even better than that. So I think looking at things like gold, I'm a third year in a row, I'm a gold bull, looking for a weaker dollar, take advantage of that, get some overseas diversification, look at sectors maybe that aren't tech, that maybe aren't as highly valued but have some structural themes to them, and some that aren't cheap but I think still could run, like the banks I think can still run next year. Global defense I still want to have next year. People are going to keep buying global defense. That's just the reality we're in. So that's kind of how I'm looking at it right now.
So great to have you here first.
Yeah.
Thanks for coming. The QE move, they don't call it that, but
yes.
The QE-ish move yesterday. How much do you think that adds, or does that add to your bullish look for 2026?
It certainly is affecting sentiment right now. The Fed is trying very hard to say this is not quantitative easing. This is a tactical move to ensure market functioning. If they do 40 billion purchases on the very front end of the yield curve for a month, that's tactical. If this goes on for 5 or 6 months, they've suggested through tax day, so the beginning of April. If it goes that long or longer than that, it's going to start getting more speculation in the market that maybe we have more activist bond management going on. The Treasury is issuing a lot of the debt next year at the front end of the curve to try to keep 10-year yields low to help the housing market. But by pushing all that issuance to the front end, there's pressure on the front end to rise, so the Fed is helping offset that. It's going to create a conversation that maybe the Fed and Treasury have some sort of new accord. I don't think that's what it is, but if this lasts for 4 or 5 months, that conversation will pick up speed.
Rebecca, let's talk about my old friend, your old friend, international markets, and in a world where the Fed may actually be pumping more liquidity and at least easy.
Yeah.
What do you think? Because this was the year to own international after many years of not, and I think it continues for some of the same things that you set up your conversation with.
Yeah, Tim, I totally agree. I mean, as much as we're applauding the U.S. recovery from the April lows this year, the rest of the world, almost all of them, not all, have done much better. And a lot of that is the tailwind coming from the weak dollar. Not only, but a big part of it. The dollar next year maybe doesn't get as much juice lower. That's weird. Anyway,
Understood. The juice it will give, for sure, yeah.
The dollar isn't going to fall because the Fed is easing aggressively next year, but it's the differential. So Australia is looking like it's going to raise rates. Europe is actually talking about maybe raising rates, certainly not cutting more next year. Japan, of course, is going to raise rates maybe as soon as later this month. Yep. So you've got this difference between the rest of the world and the U.S. I think that is a headwind for the dollar. And I do think we're going to continue to get diversification from other central banks out of the U.S. It's not an overnight crisis. It's a slow drip, drip, drip. But that's also going to weigh on the dollar.
So you said, of course, AI capex.
Yes, of course.
That's sort of there's some doubts about that trade right now. And so if that doesn't come through as one of the bullish tentpoles next year, how does it offset the other bullish tentpoles that you laid out?
given the still high valuations, the concentrated market ownership, and the fact that this has become such a big part of the S&P altogether, if there is anything that pulls this Jenga block out of the tower, we're at risk of something falling over. Because AI has helped create the wealth that's led to consumption, which supports earnings. And it's also the capex is feeding through into business investment in the economy. So if they disappoint expectations, there is a major risk. Now, the question is, does it fall 75% like it did in 2000, 2002 with the NASDAQ when the dot-com bubble burst? Or is it more like a little deflating the bubble? We'd lose 20, 25%, and then we kind of come back. I don't know which it is. But I do think that risk is very alive and well. And again, that leads me back to having tempered optimism. Right.